And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Well, it's about 24 to 5, and it's about, I forget what it was now. I did look a minute ago. 13 degrees. There we go. It's about 13 degrees outside at the moment, although when I was out there earlier, it did feel a bit chilly. Yes, there's a breeze, you see, so that means it feels like 8 degrees. Mostly clear is the word on the weather for the remainder of today. Partly cloudy tomorrow, partly cloudy on Sunday. A shower or two creeping in for the public holiday on Monday. Well, it's about 24 to 5 now on 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Yes, it's that time of the afternoon once again on a Friday, and it's time to say good afternoon to Luke Smith.
How are we?
Very, very well. And today you've brought with you a bodyguard to fend off the questions that you can't handle.
Look, exactly. And we promised a couple of weeks ago that in light of what's come up in the budget and all of the noise and the hoo-ha and the could be, should be, is this me, is that not me, I thought it'd be a great idea to get Rhys in from RSM because tax is his world and we can try and touch on a few key areas, demystify some of the sort of assumptions that are out there, and he can lay out at a very sort of high level, hey, what have we done about capital gains? What have we done about the trusts? Because that's a really topical one. And then we can touch on the negative gearing. But I think the most important thing from today is nothing's law. It's all a good idea. And then
hang on a minute. So a lot of people out there saying this is not a good idea.
Well, and none of it's a good idea. Let's preface that right out of the gates. But I guess we just want people to get a bit of context. And also remember that until stuff is law and we have detail, which, Rhys will touch on, let's not go leaping to conclusions or assumptions until we have the facts.
Yeah, so basically at this stage it remains an idea, it's a proposal, it's not yet legislated, it's not yet law, although the very first pieces of the tax legislation I think have been introduced this week, but we still don't have all the detail and the government is still talking about potential carve-outs and exemptions in relation to the capital gains tax changes, and none of that is clear as yet. So, Rhys, can you elucidate what is actually going on?
Is very confusing, isn't it? We've heard from the government. I reckon they've got the worst PR advisors out there. They've talked about all these changes to bring about housing affordability and intergenerational wealth, and they've brought in these changes that applies to everyone.
Yes, and I still don't see how it's going to make houses more affordable.
Well, they said in the budget paper, 7,500 people a year are going to be benefited from this.
Is that right?
Yep.
And it's a lot of people, isn't it?
It is, but there's 2.2 million property investors that are going to be affected.
Pretty sure you detected my note of sarcasm.
Yeah, I did.
Yeah. And I think that's it, right? It's about understanding how does it affect me as an individual? Because from what I can gather is it was sold as something that will help the younger generation get into houses. Well, I can't see how that's going to be a benefit. And depending on how you look at some of the negative gearing rules, it's actually helped an older generation with existing portfolios. And you and I were talking about this the other day where you can't claim negative gearing against income. But if I'm 65 and have 10 houses and have rental income that comes in, I can negative gear against that.
Yes, you can.
Correct. Yep. Yeah, so it suits people that are already in the market. And it makes it challenging for people that want to get into the market into existing properties.
Exactly.
Because the new rules are about benefiting people buying into new properties.
That's it. So we need to try and give people incentive to buy new properties, but we can't build them fast enough because of the red tape. Because we've got more people coming into the country than we can actually house. But we've sold the budget as, well, it's going to help younger people and transfer wealth. But a lot of the rules when you get down into the interpretation and the execution of them, like that example, help people that are already existing investors continue to do what they're doing, but penalise younger people. Which
one of the arguments that I've heard quite a lot lately is that what these changes will actually deliver is it will deny the opportunity to younger people to use the same mechanisms as previous generations have used to increase their wealth. So if you're starting out today, well, you can't rely on negative gearing. You can't look forward to a 50% discount on your capital gains tax. You can't use those same things at all. So what do you do instead? Are there any alternatives?
It's a good question. The one thing I see when you talk about creating incentives is that with these new rules, the banks have been changing their lending policies. And they're saying for someone to want to buy a negatively geared property, their lending capacity has reduced from between 220,000 to 300,000. So if they want to go buy a property in the market at the moment, that's their purchasing power has reduced by that as a result of the change.
That's quite extraordinary.
That's significant.
It's very significant. Absolutely, it is. So, for people that are concerned about what this means for their investing future, what do they need to consider? Let's start with property first. If people have got an investment property, do they keep it? Do they sell it? What do they need to consider?
Well, I think they need to be cautious, and we have to wait for the rules to come out. I think we need to keep in mind as that if these rules come into play, how existing property owners are going to be affected. With these proposed rules that it's going to come in, people that have existing properties that want to sell down the track, their only market is going to be people that want to own or occupy that property, or someone that has a lot of cash behind them and can positively gear it. If that's not the case, then the market for these properties is starting to reduce. So I'll give you an example, Leon. If I owned and I'm just picking on one cross-section, if I owned a DHA property and it was on a 10-year lease, if I decided to sell that in 2 years' time, the only person that's going to want to buy it is a property investor with a positively geared portfolio. Because if I bought that, I can't negatively gear it.
Now, okay, negative gearing is itself a simple equation. If you make a loss and you have other income, you can use that loss to reduce your other income and reduce your tax liability across the board. Now, if I'm an individual and I own my investment property as an individual in my own name, there's no trust, there's no company structure, I am a single economic entity. Why can't I write off that loss?
Because the government said you can't.
But that's just not fair.
It isn't fair.
It isn't fair.
But they say, look, if you own an existing property by budget night, right, you can continue to negatively gear that property.
Yes. So, as a hypothetical property investor, I'm not affected about
you are
that.
Not affected.
Because I've already owned that property. But for people that are considering investing in property in the future, even if they've got a substantial deposit and they positively gear their property, all it takes is one bad year where you've got a bad tenant that causes damage and you lose rental income. All of a sudden you're making a loss in that year.
Correct. And that loss has to be carried forward to next year to when you make a profit, or ultimately when you sell the asset and hopefully make a gain.
Well, there's no guarantee of that happening either.
No, there's not.
Indeed. All right. So that's a quick look at the property investments. These changes impact on pretty much all investments, don't they? What about people who own shares?
It affects all assets, crypto, shares, paintings, cars, some fancy cars. It affects everyone.
Hang on. If I buy a car and all of a sudden they don't build Holdens anymore, I'm going to be penalised for that?
Well, there are certainly some complications to collectible assets and personal use assets. But yes, correct. You're going to be caught in those rules.
I mean, hypothetically, my 1998 VS V8 Ute, which I have in Brisbane, is actually worth twice what I paid for it now. But I'm not planning on selling it anytime soon. But it's just, I mean, I didn't do that as an investment.
Yep.
So they're coming after me anyway.
Well, they're coming after everyone.
Yeah.
It's applying to everyone, young and old. If you're trying to invest for your future, effectively after 1 July 27, there are new rules coming in that's going to increase taxes on things.
Okay, and basically make things more difficult. The other big ticket item, of course, is the change of treatment for trusts, and in particular, discretionary trusts.
Yep.
And that includes apparently discretionary testamentary trusts, which has prompted a lot of discussion. But what does it actually mean for people? Most people don't have a trust, but certainly there are significant reasons for certain individuals to have a trust, and it's most appropriate. So what is the impact of that?
So there are 850,000 discretionary trusts out there, Leon.
Okay.
And under these proposed rules, you've effectively got 3 years before anything changes. But after that, the rules as it's proposed is that this trust, there will be a minimum tax applied to distributions out of these trusts at 30%.
Right. Even if you have no other income?
Correct.
But that's not fair either. Where's your tax-free threshold?
Well, what happens is the trust, you're right, so what happens is the trust will pay 30% tax, and then it passes out to you as an individual. And if you have no other income and you're below the tax-free threshold, correct, you don't get any refunds. So if you own those investments in a trust, you're missing out. But if you owned it in a company, you'd get a refund for that tax paid.
Okay, so over the next couple of years then, people would probably be looking at shifting assets from trusts into companies.
Correct.
So if everybody does that, then the government's no better off, are they?
Correct. But what they feel, Leon, is that there's all these people saving lots of money with trusts. So we're going to complicate it, and we're going to basically make it that it was so disadvantaged to operate that you need to not use one.
The one thing that upset a lot of people was that this change also applied to testamentary trusts, and there can be all sorts of reasons why a person might put their assets into a testamentary trust, particularly if they've got younger kids that need to be protected until they're old enough to manage the money, or if they might have adult kids who are affected by a disability and they need care as well, and you might want to set up a trust in order to provide for that. Now, surely the government's going to leave that alone, aren't they?
Well, yeah, the distinction is tomorrow I could set up a discretionary trust for you tomorrow, Leon, and you can start operating it. A testamentary trust is different because it is formed under a will. So you would have to die, and then the will creates a trust deed, and that's keeping assets in play for its beneficiaries.
Exactly.
Now,
they're going to tax that, are they?
They're going to tax it.
Why?
Well, he's
again robbing from the dead, right?
They're applying across the board now. It is deeply unpopular, and they're looking to backflip on it because it is a pseudo death tax.
And that's also in addition to the tax on the taxable contribution that comes out of super that's already in place that no one's ever called a death tax. But we know that we incur 17% on the taxable portion of our super paid to non-dependent kids. So with that in play, and if money then came out to a testamentary vehicle where in the past you've had the ability to take advantage of minor children being beneficiaries and getting adult marginal tax rates as a speciality of that vehicle. Again, as Rhys said, it's like we're going to punish everyone and make it so ugly that they won't do it. There'll also be instances where if somebody's fortunate enough that, well, I pay 30% in there, that might be better than their marginal tax rate. So it's not that they're always going to die. It's just that you'd have to look at things on a case by case and say, does it suit my situation and my broader income profile? And then somebody like Rhys says, okay, but we could do it better here. We could have this flexibility there. We could use this here. It's not that we want people to go, right, trust the dead and they're horrible and they're not useful. There is still a use for it. But you have to look at it as a broader part of your income position to say, what are the implications of these ridiculous suggestions to then broadly penalise people with the assumptions that trusts are for the rich and trusts are for those that are dodging stuff. It's not the case.
Now, I have one more question, and this goes back to the capital gains tax, and I may have got the wrong end of the stick on this one. I don't know, because a lot of what the government has said has confused me. I may be a simple boy, but this is the thing. That 30% minimum tax rate on the distributions of trusts, isn't there also a minimum 30% tax rate on capital gains?
Yep, good point. Correct. For gains from, as it's proposed, as I understand, from 1 July 27, that we move to an index-based measure or inflation-adjusted measure for capital gains tax.
And that's fine. I can live with that.
Yep.
But a minimum 30%.
And then there's a minimum 30%.
But hang on
that.
What if that's my only income? Where's my tax-free threshold?
There isn't that.
But that's not fair.
Correct. Correct.
And that's why we're sitting here pointing this out.
Correct. Is that they're trying to tax everything like everyone's a salary and wager. If you want to have a go and start putting money aside for your future, we're going to take a fair whack at it.
Okay, look, I get the idea of taxing everybody on a basis that levels a playing field and we're all treated in a more or less equal fashion. But this goes beyond that. We're no longer being treated preferentially, instead being punished. So that if you are a person who relies on a distribution from a trust for your income, or if your only source of income is capital gains from your investments, in both cases you're denied the access to the tax-free threshold that's available to everybody else.
Correct.
That's not fair.
It isn't fair, but you're right. It isn't fair. But what the government's trying to do is they're saying we're going to provide some opportunity or some concessions, some rollover relief for you to roll from a trust into another structure. That's their sugar hit to say we're not going to disadvantage you. We're going to allow you to roll out. And they're saying what you'll do is you'll avoid paying income tax on it, Leanne.
Yeah.
But the big thing that isn't talked about is that if I own real property in these trusts.
Yeah.
I own a house or an apartment or a commercial property. If I move it from a trust to a company or into my personal name, there's stamp duty.
Of course there is. Of course there is.
And I believe the governments are saying, the state ones are saying, I'm not going to give you any concessions.
They're not going to do that. Absolutely not. And why would they? Rhys Kyburz from RSM, Luke Smith from Envision Financial are with me in the studio today, picking apart the tax implications of the recent federal budget. Nothing is yet set in concrete, and we're still confused about some of the measures, but we'll be back with more in just a moment. Smith from Envision Financial and Rhys Kyburz from RSM are both with me in the studio today. We're pulling apart the recent federal budget and the tax implications. So at this point, in summing matters up, what are the key points we need to remember?
Well, I think we can start with none of this is law yet. And as Rhys has said a few times, the devil is in the detail and we don't have that yet. So I think if you're at home and the point of today was really to say, look, let's not start throwing spaghetti at the wall and hoping that it sticks because we don't know where the wall is going to be set. So find out how it affects you, get some advice in relation to what can happen, what has been made law, and does a carve-out apply or not apply to your situation. And also keep in mind at a high level that just because something has changed, it may not necessarily impact you the way you think it does because of your broader situation. You know, if your marginal tax rate's over 30%, a 30% tax may be better than 49%. So we can't just lump everything out as bad. I think from an estate perspective, people will need to then engage with their family lawyer. If the testamentary side of things does get changed, I think it's a horrible indictment as to where we are. But people are going to need to start thinking about their estate planning documentation, because if testamentary trusts, which have always been a wonderful vehicle for asset protection and the ability to distribute income generationally, if that's taken from a strategic standpoint, you may then need to think about, well, what do I do for the next generation? Or pick the lesser of two evils. I'd like the assets protected. Does that mean I then pay more tax? That might be the compromise that you're willing to take on. So let's not have people look at, this is horrible, get rid of it. Think about how you can work it to your situation. And I think from a vehicle perspective, that's the sort of general thinking, isn't it? Where can we put it?
Spot on. I mean, it's getting advice, talking to your advisors. You know, if it's a testamentary trust, we need to review the wills, speak to your accountant, speak to your mortgage broker. If you're looking to sell and take profits, can you get back into the market at that same level of borrowing? Yeah,
and as we say, we always looked at a family trust and a company with the distinction of, well, the family trust gets a 50% discount. Well, now it's a level playing field. People need to adjust their thinking and say, well, investing in a company may be the way forward for some people.
Yep.
And not to discount that as an option.
Correct.
Yeah, so I think people really need to sort of assess, how can I use this and get something positive out of it? Because there's not a lot of positive news for your hardworking Australian out there. But I think, as Rhys said, the trusted advisor, the considerations of the rules, how we can do it and where we can move assets. And look for the sneaky ones. So here's federal law,
yep.
But the state-based law says, oh, no, we're going to smash you because company to trust is a change of beneficial ownership and we want stamp duty. Now, if they're honest about giving people concessions, they should all be on the same page there from a federal and a state perspective. If they're not, it really shows a lack of planning and a lack of thinking as to the execution of these sorts of things.
All right, where can listeners get more information?
Yeah, so 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify, and we've got Envision Financial Canberra on YouTube, and we've got Smart Money Strategy, your ultimate guide to financial planning. If people want to reach out, Rhys, where can they get you?
Give me a call, 6217-0300.
There we go. Look at that. He's remembered his number this week. How good. How good.
Fantastic. All right. So thanks very much, both of you, for coming in today and hopefully helping out to shed a little bit of light on some of those forthcoming changes. Rhys Kyburz from RSM and Luke Smith from Envision Financial. Thanks very much.
Thanks,
pleasure, mate. See you next week.
Luke Smith will be back with us again at the same time next Friday afternoon with more financial matters.